Mr. Deshapriya, Mr. Yagi, Mr. Mohanty, Deputy Governor Ranasinghe, Mr. Amarasuri and Mr. De Silva from Lanka Clear, my colleague Mr. Coomaraswamy, who has given me some very useful speaking notes. Ladies and gentlemen, it's a great pleasure to be here with you this evening, and I'd like to thank Lanka Clear for inviting me. This is an excellent opportunity to celebrate the technological progress that is being made in the financial services sector, and it's also an occasion to celebrate the partnership that has been forged between JCB and Lanka Clear. Now, when you're in my position, when you have a captive audience before you, it's impossible to resist the temptation of trying to explain a government policy before one gets to the subject matter at hand for the evening. So I'm going to spend the first 10 minutes very quickly running through some of the priorities that the government has in terms of its development plans. Looking around the audience, some of you have heard this before, so I'm afraid you're going to have to listen to it again, and I apologize for that. But in terms of trying to explain what the government is trying to do, I'd like to segment my remarks into three. To start off by what we're trying to do in terms of strengthening the macroeconomic fundamentals, then to talk a little bit about the growth model that the government is trying to construct, and finally to give you a thumbnail sketch of some of the major development programs. So if I can start with the macroeconomic fundamentals and what the government is trying to do there, clearly, as all of you know, the Sri Lankan economy has been subject to repeating cycles of stop-go policies. And the underlying instability has invariably been caused by the government's fiscal operations. So the number one priority as far as macroeconomic stability is concerned is to get the government fiscal operations under control. So the government now has plans for a revenue enhancement-based fiscal consolidation program, which is intended to get the budget deficit down to 3.5% of GDP. And that trajectory is embedded into the IMF's extended fund facility. So that's the framework for the fiscal side. And that, if we don't get that right, we will keep repeating what we've been doing in the past, which is we have a couple of years of decent growth, and then we slam on, we get a balance of payments crisis, inflation picks up, we slam on brakes, and then we start all over again. But each time from a lower base. And the government's debt dynamics are such that we simply cannot afford to keep doing what we've been doing in the past. So it can't be business as usual. We have to fix the fiscal side. Otherwise, we run into serious trouble. What are the frameworks for monetary policy and exchange rate policy, which is more directly under the purview of the Central Bank of Sri Lanka? On the monetary policy side, we are transitioning to a flexible inflation targeting framework. Without going into the detail, if you want the details, it's available in the Central Bank's roadmap, which was put out in early January this year. But what we're trying to do is to really have a much more forward-looking, proactive monetary policy, which sets interest. There's a lag. You know, when you set interest rates, the pass-through takes about a year. So you don't get the full pass-through for a year. So when you're setting interest rates today, you need to have a view of what inflation is going to be like 12 months down the line. So you have to build the forecasting capability. You have to build the modeling capability to do that forecasting, which is what the central bank is currently doing. So by having this proactive, forward-looking monetary policy, the benefit that you get is that the volatility in interest rates gets smoothed out. The peaks and troughs get smoothed out, so you have a more gradual movement in terms of the interest rate structure, which of course for business planning is a major advantage. So which is what we're trying to put in place now. On the exchange rate, historically we have tried to defend the rupee by using our reserves, which for me is really a bit of a no-brainer, because that you shouldn't do that, because if you it is impossible to defend the exchange rate when the fundamentals don't justify it. Sooner or later, you have to depreciate the currency. So, for instance, in 2011, 2012, we spent $4 billion US dollars of our reserves, much of it borrowed, to defend the rupee. And at the end of it, in February 2012, we depreciated the currency by 14.5%. So you lose $4 billion worth of reserves, you depreciate by 14.5%. In 2015, just to show that all governments make the same mistake, in 2015 we spent $2 billion US dollars of our largely borrowed reserves, and then at the end of it, depreciated by 9.5%. So this is clearly an absolute no-brainer. So we want to move away from that, to have a more flexible exchange rate policy. And what we're trying to do is to gradually depreciate the nominal exchange rate to get the real effective exchange rate index to 100. That is the point at which you have a competitive exchange rate. So the objective is to have a competitive exchange rate. It will take a bit of time for us to get there. Once we get there, we want to adjust the nominal interest rate to keep the real effective exchange rate at 100. Now, just to give you an example, if we are, the inflation target that we have in mind for our flexible inflation targeting framework is a range of 4 to 6%. If you're able to keep inflation at 5%, for that, it's going to be crucial that the budget deficit is brought into shape and that there is no excess demand coming from the fiscal side, and we have to have proactive monetary policy, which does not create too much credit in the system, leading to inflationary pressure as well. So if you get fiscal and monetary policy right, then you can have low inflation, and if we can keep inflation at 5%, inflation amongst our competitors and trading partners is currently 2.5%. So then if we are able to move the exchange rate 2%, 2.5% a year, we can maintain competitiveness. If we can have a 0.5% improvement in productivity, then you need to do 0.5% less as far as the exchange rate is concerned. So doing 2.5%, 3% right through the year very gradually is something businesses can plan for. So what we're really trying to do is to create frameworks which makes it very transparent as to what we're trying to do, and hopefully help businesses to plan their futures on a more certain and predictable basis. The growth model, arguably the biggest indictment of the policies we've had over the last 10, 15 years is the fact that the tradable goods sector, that's imports plus exports, as a percent of GDP, have come down from about 75-80% of GDP to about 45. For a relatively small open economy, that is really a very, very unfortunate outcome. So this is what we've done. We've done completely the wrong thing, whereby, if Singapore has over 100%, it's a very open economy, but to go from 75, 80 to 45 is really, it means you basically close out the option of having sustained growth and productive employment creation. Because essentially what you're doing is trying to rely only on the non-tradable sectors, which with a population of 20 million and purchasing 21 million and purchasing power of about $3,800 per capita, you are not going to get very far in terms of driving growth, getting 7-8% growth per year, and creating productive employment, higher value employment, which is what the ultimate objective is. So we've got to reverse that. We've got to reverse what has been happening over the last 10, 15 years. We've got to have more exports critically, and to really the growth model one needs at the moment has probably 3 elements. One is, given the government's fiscal constraints, the lack of fiscal space, it cannot be a state-driven development model. Now, I've worked in the public sector all my life, so I'm not one of these people who is ideologically committed to the private sector being the panacea of all ills. You can see different mixes of the state and the private sector giving very good development outcomes. You have China and Vietnam at one end, and you have much more market-oriented economies at the other, all of which have got development outcomes. So really is to have sound policies. The mix of the state and the private sector can vary. But in our case, the government just does not have the resources to drive the development process because of our very onerous public debt that we have incurred over previous years. Given that, it has to be a private sector driven process and with a major role for PPPs as well, particularly BOTs. So it's got to be private sector and it's got to be exports because, as I said, with the market size that we have, we can't drive, and the purchasing power we have in the economy, we can't drive growth on a sustained basis by selling just into our domestic market. So we have to leverage external demand. And if you look around the world at the countries that have been successful in terms of export transformation, FDI has invariably played a role. Whether you're as large as China or as small as Singapore, FDI has played a very important role in driving export transformation. So it's private sector driven with exports and FDI as key pillars. Now there are those who will say, is this the right time to go for an outward-looking, export-oriented model when the world economy is sluggish, international trade is subdued? Isn't it really not the right time to be depending on external demand to drive our growth? The answer to that, in my view, is that the fact the subdued prospects for the global economy, though they are improving at the moment, the relatively subdued prospects of the global economy are trumped, as far as Sri Lanka is concerned, by its geographical location and its excellent international relations. If I may explain, the fact that we are 20 miles from the fastest growing large economy in the world, the fact that we are right in the middle of China's maritime Silk Route, the fact that we have excellent bilateral relations with the major capital surplus countries of Asia, Japan, China, the ASEAN countries, all this means that we can leverage our position and our international geographical position and our international relations to attract investment in here. And the current dynamics of the geopolitics of the Indian Ocean also is something that we can leverage if we are clever about it. So if you bring all this together, there is a tremendous opportunity for Sri Lanka. So we're trying to get the macro framework right. We're trying to see whether that we have a clear growth model. What is the government doing to support that growth model? It's in terms of the investment climate, it's got 10 task forces for each of the pillars of the World Bank's Doing Business Index, which is looking at how you can have deregulation to improve the investment climate, to see where technology can be infused to improve the ease of doing business. There's also investment promotion is being made much more focused to see what subsectors we can jump into so that we have greater complexity and diversification in our export basket. We have to shift, I think, while consolidating and building on the traditional export markets in the West, we clearly need to build our access to markets in the East as well. So the investment promotion is going to be driven in that respect, within those parameters, to look at the subsectors and also to look at key players, anchor investors in those subsectors. For instance, Samsung accounted for 40% of Vietnam's exports at one point. Intel accounted for 75% of Costa Rica's exports at one time. So if you can get one or two key anchor investors, they can have a transformative impact on your export performance. So that's the kind of framework within which investment promotion is going to take place going forward. And the other two areas are trade facilitation. I think the single electronic window at customs and a one-stop clearing unit in the central clearance unit of customs are all things the government is working upon. But arguably, the jewel in the crown is trade policy. First, what the government is doing is putting in place policies to make sure that there is a level playing field for domestic producers. One is an anti-dumping bill is now already in Parliament and should be enacted soon. Two, there is a trade adjustment package the government has solicited the help of the World Bank and the International Trade Center to come up with a package which will help domestic industry become more competitive in the face of more competition, and to help local workers to retrain where their jobs are again under threat through this opening up that is likely to come. So, and of course the third element are these trade agreements, or the bilateral economic partnership agreements that are being negotiated. The current free trade agreement in goods with India is being extended so that services, investment, technology and training are added on. Similar agreements with China and Singapore. There is already a bilateral free trade agreement in goods with Pakistan, and of course now GSP Plus has been restored. Now, if all that works out, if we are able to negotiate those agreements successfully, in say about a year's time, Sri Lanka could have preferential access to a market of 3 billion people. That's China, India, Europe, Pakistan, and Singapore. I don't know of any country which has preferential access to China, India, and Europe. I think, if I'm not mistaken, Singapore has preferential access to China and India, but nobody has access to China, India, and Europe. So that's the USP that we have. And what we can do with it is clearly to provide opportunities for our own exporters, but possibly the bigger prize is to leverage the trade investment nexus to attract FDI. I mean, there are 190 odd countries in the world all competing for FDI. But if you can say we are the only country that has preferential access to this market of 3 billion people, clearly we have a unique selling proposition. So that's what we have going forward. Things can go a lot faster, but I think the direction of travel is positive. And hopefully, as we move forward, there will be a momentum that builds up. So, but the third segment I was going to talk about was the government's major development program. That I think all of you know. You know the Western Region Megapolis Plan, the International Financial Center and the Port City Development, Hambantota. Now Hambantota, I must say, clearly a high priority for the country is that we negotiate the best possible deal in terms of the long lease of the Hambantota port. But I think it's a grave mistake to look at that just in terms of the port. Because if China Merchant or a Chinese company gets the port, China has plans to invest maybe up to about $5 billion in that area in terms of industrial zones. Now, if we are honest with ourselves, it is really an indictment on all of us that 69 years after independence, next to nothing has been done for the people of Monragala. Next to nothing has been done for the people of Uva. The people of Hambantota have some assets, but they're not really working for them. So what this leasing of the port does is catalyze the possibility of massive development of a lagging region in this country, a region which has been actually the heartland of the two JVP insurrections, during which thousands of young lives have been lost in this country. So I think that's the big picture one needs to look at. Not really, as I said, negotiate the best deal possible, but this is not just about the port. It's about the unleashing of the potential of that whole area, which has been not had the benefits of development that it should have had. Similarly, you go up to Trincomalee, there are plans for the Japanese, the Indians, and the Singaporeans to work together to develop Trincomalee, and that should benefit not just the area in the east, but the idea is to improve connectivity with the Rajarata areas so that the people of those regions can also benefit. And there are special incentives that are going to be given for investment in the north, for instance, 200% investment relief. So, and Japan is doing a master plan for the development of Kandy. Korea and the Andhra Pradesh Development Corporation have interests for industrial zones around Kurunagala and Kuliyapitiya. So all this is out there. Now, the challenge is to execute. If people, when they ask me what are your 3 top priorities, I would say it's execution, execution, and execution. Can we get it done? The plans are out there. Can we get it done? The jury is still out. That's where we really need to get together. Whether it's not just the government, I don't think it's enough to sit back and say the government has to do it. I think it's necessary for everybody to get together to make this thing happen. And in these large projects, there's a lag time. It's going to take 12, 18 months before there's real traction. In that intervening period, the domestic private sector has to think whether it should recalibrate its risk appetite. Because up to now, it's been sitting on the sidelines. The interesting thing is, we're getting foreign money into the stock market. We're getting some foreign money into the government securities market. We issued a sovereign bond in March, 1.5 billion. There were bids of 11 billion, 7.5% oversubscribed. So the foreigners seem to have faith in the future of Sri Lanka, which doesn't seem to be shared by our domestic private sector. Which I'm not saying that is entirely the fault of the private sector. Government has to do better itself, better at explaining itself. It has to give more predictable and consistent policies. That is what I was trying to explain to you in terms of the frameworks that we are putting in place. So hopefully, going forward, those of you, all of you in the private sector will think carefully about recalibrating, as I said, your risk appetite. So let me now move on to the subject matter at hand. I think very timely that Mr. Mohanty is here because one of the things in the central bank that we've been thinking about is how we respond to fintech. As you all know, we have a banking sector with 26 licensed banks and 6 specialized banks. We have a non-bank financial institution sector with over 50 institutions with a long tail. And one worries whether the disruptive aspects of fintech could cause a great deal of damage to our banking and non-banking financial institution sector. So as a regulator, what one really needs to do is, clearly one can't ignore the enormous benefits, the potential benefits of fintech. But how does one really phase the progress in the advancement in terms of the technological change that fintech offers without having too much disruption to the domestic financial services sector? And interestingly, what Mr. Mohanty said is that you can have a modular approach where you can phase this in a way that minimizes the disruptive capacity. So I think it's very welcome that he is here, that he is offered to collaborate, and certainly I think my colleagues will look very carefully as to how we can learn from what the Monetary Authority of Singapore has done on its own, for itself, as well as what it's been doing as collaborative partners for other countries. I don't think one needs to reinvent the wheel, and we can maybe look to see how we can phase in fintech with the least possible disruption to the existing financial sector. Now, Sir Arthur Clarke, in his foreword to his collected stories published in June 2000, stated, "The dinosaurs disappeared because they could not adapt to their changing environment. We shall disappear if we cannot adapt to an environment that now contains spaceships, computers, and thermonuclear weapons." In today's world, 17 years later, this sentiment is even more pertinent and has even greater resonance as we are living through the 4th industrial revolution, characterized by robotics, artificial intelligence, and 3D printing. With the advancement in telecommunications, electronic payment systems are rapidly replacing the traditional modes of payments. As you all know, the central bank took the initiative to establish Lanka Clear in 2002 and divested the operations of check clearing and slips with a view to introducing new technology to improve efficiency and effect cost effectiveness. Over the years, there has been a gradual transformation of the banking activities from manual to digitalized processing, with commercial banks introducing computerized methods for their day-to-day internal operational activities. Lanka Clear, under the guidance of the central bank, transformed the clearance systems of the country by introducing innovative technologies to improve the efficiency of retail payment mechanisms. In addition to revolutionizing the check clearing system and slips, Lanka Clear also launched systems to cater for all retail payment systems. implementation of the common card and payment switch is a landmark development in the payment and settlement infrastructure of the country. On the whole, these developments offer convenience and security, as well as time and cost-saving benefits to consumers and financial institutions, while reducing the currency management costs of the country. Efficient mechanisms to effect transactions are essential prerequisites for a development-friendly financial system, as every economic activity depends on the efficacious and timely movement of funds. It is vital to ensure the efficiency and safety of the payment and settlement systems of the country to achieve the price and economic stability, which are key objectives, which are core objectives of the Central Bank of Sri Lanka. Accordingly, as a regulator and the catalyst of the payment and settlement systems, the Central Bank constantly seeks to set the regulatory parameters to foster financial innovation while striving to mitigate associated risks. However, we are aware that we need to evolve to keep pace with the exponential acceleration in the speed of technological change. And here, Mr. Mohanty's insights about the importance of experiments has much resonance. Here again, I think we still have, this kind of white paper mentality of trying to get everything absolutely right before we roll it out. I must say my own instincts are to go in that direction as well. But it's interesting to say that the way forward is really to conduct experiments, to be willing to take some risks, not to have the fear of failure. That's why Pakistan won the Champions Trophy, because they had no fear of failure. They had nothing to lose in that match. So I think if sometimes it's good to set aside the fear of failure and to take some risks in a prudent and structured way, but maybe we need to be a bit bolder than we have been. To reap the total benefit of new payments products, it is essential to ensure full implementation of CCAPs. Also, all stakeholders need to facilitate the introduction of the National Card Scheme as a measure to reduce transaction and other costs. And as I said, we are very pleased that we've been able to come to this agreement with JCP with their excellent track record. Digitalization of government payments should be another priority. With the introduction of electronic payments, the payment and collection process of the government will also be streamlined, ensuring timely fund flows. As the first phase, the Central Bank is facilitating the implementation of an online payment system for Sri Lanka Customs, and this will be extended to other departments as well. It is also important to ensure that priority is attached to ensuring electronic payments eventually reach all parts of the country and every segment of society, including underserved populations. That, I think, is the theme of this evening, and clearly it's a priority that we need to have clearly in our sights as we go forward. Fees and charges should not be a barrier to achieving the goal of a financially included society through electronic payment systems. Having a sound payment system and effective products is only part of the story. Creating awareness among the general public is also vital to boost the usage of new financial services and enable people to make right choices for a sustainable financial future. This event, organized by Lanka Clear to recognize the services of banks and other financial institutions in promoting electronic payments, is to be highly commended. Innovation in payment system is of paramount importance as we promote financial inclusion, which is crucial for balanced, good quality growth. I congratulate the organizers for putting forward such a successful event. Let me conclude by inviting all the stakeholders of the rapidly evolving payment landscape to work together in order to preserve the credibility of the payment systems and the people's trust in them. Thank you all very much.